Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Welcome to the Joss Brown Podcast, where we unravel the mysteries of retirement planning. I'm Michelle Robinson, and I'm here today with Danielle Joss. Today's episode is dedicated to understanding employer-sponsored plans and how they could shape your retirement future. So, welcome to the podcast, Dan Joss.
Thanks. Let's go.
Let's go. What is the difference between a defined benefit plan and a defined contribution plan?
I think it's who gets the risk.
That's right.
Defined benefit plan is the focus on the benefit or the pension. Mm-hmm. And that's employer risk to pay that out over the lifetime of the retiree. Mm-hmm. Defined contribution plans, there's several of them, are the employer needs to fund their plan. Mm-hmm. So that's, your 403B or your 401k. Mm-hmm. Employers has the responsibility to fund their contributions.
Correct. And there's a guaranteed paid out on the defined benefit, while there's not a guaranteed paid out on the defined contribution. That's a big difference because whatever, and like you mentioned, the risk. And so whatever is in their account balance when they retire, that's what's going to get paid out on the defined contribution versus the defined benefit. There's a calculation done at the beginning. And so they know what will be paid out when they retire versus defined contribution.
And I guess ownership also.
Yes.
It's not your asset under the pension plan. Mm-hmm. So when you pass away, there may be a benefit for the survivor, but not your heirs.
Right.
Defined contribution plan is yours.
Right.
So if you don't spend it all, or if you spend it all, like you said, there's a guaranteed payment on the pension plan. There is no guarantee on the contribution plan, which means there's no top side or bottom side. You could have some left over for your heirs. Mm-hmm.
And you touched on a great point there, Dan. You said ownership. And so in the event a company decide that they're going to cease the pension for the defined benefit plan or the employer-sponsored plan, what happens to that if the company goes out of business? What happens to the employer, the employees' benefit at that point?
I don't know. This insurance probably. But it's severely, your income is cut.
Exactly. So where did...
And not likely to go out of business, but what we're seeing with some municipalities is the pension plans are underfunded.
Yes.
Which means everyone will get a haircut.
Right.
So that's the risk of... That's the risk.
It is.
So you could take market risk, and I'm not sure which I would prefer if I had the choice of these, but it's not our decision. The decision will be who is your employer, and you could pick, I want to work for the federal government, I want to work for a state government, I want to work for a local municipality, or I want to work for a private company. Wherever you go to work, that's their plan. And that's why we're saying this is employer-sponsored plans. You pick your employer, the plan is already there.
Exactly.
And you come to talk with us, and we'll make the best of it.
Exactly. And there's a risk involved in anything. So.
And we help clients go through the initial question at onboarding. If it's a 401k, 403b, which investment choices and how much should I put in? And if you're employed at a place that's going to give you a pension, sometimes you pay for that. And the question is on the employee, how much, do you want to put in 5 or 10 or 15% towards your retirement? And we can help you work through that decision.
So we've often seen on the onboarding side, Dan, where many people are leaving cash on the table. Why do you think that's happening?
I don't know. What do you got?
I think it's happening because they don't understand their benefits. And I'm thinking that they don't understand that the company is giving them a match, which is $3 on the table. So if there's $3 on the table, why not get the $3? And some people aren't even participating in the employer sponsor plan where they're $3, and so they're leaving that on the table. So I believe it's because they don't understand their benefits, and we've seen that a lot.
And that's raised the point of another time we talk with clients about their pension plans. It's when the plan itself changes and they have the option of going with the new plan or staying with the old plan. And so that is also, and it's usually said in the fine print, go talk with a professional about this.
Not too many people
But people
read the
that
fine
leave it
print.
off, people that leave money on the table are those that aren't likely to go talk with a professional.
Yes.
They're serious about that, and there are professionals like us out there that will spend the time with you to make sure you make the best decision for yourself.
Yes. So we've seen over the years that they have several different type of pension plans. Some of them are really outdated and many companies aren't using them. But for the most part, we have several that are the most common ones that we see that's being used now, like the 401k, the 403b, the 457, the simple plan, the SEP. Those are the main ones that we've seen, and the solo 401k for small businesses, because we do have small business owners. And so we know some of them come and ask the question, like, which one of these plans are best for us? And so talk a little bit more about when you meet with a business owner, how do you help them to determine what plan is best for them and their company?
That'll come down to what they want to achieve with their plan.
Right.
Is it to incent employees to work for them? Is it to kind of provide the basics? How much do they want to put in it? Sometimes the makeup of their employees, ages of employees, how long they'll be there, those type of things. A high turnover among employees could point us towards a different retirement plan.
Exactly. Because we know for the SEP, if you have a high turnover, then that's not the plan, because even part-time workers, depending on how they're being paid, can also benefit from a SEP. And if you're not planning as a small business to offer benefit for them, then that may not be the best plan for you. All right. The 401k, we've seen recently where they have the 401k Roth and the traditional. Is there one over the other that you share with clients that they ought to look into, or it's a combination?
Well, typically it's a traditional 401k. And we ask the question, is the Roth available? And many times the answer is no, not yet. But we're starting to see where the Roth is becoming available. And then it's just a tax, it's a math question. Do you think you'll be in a higher or lower bracket when you retire? For those that aren't sure, yeah, we like the answer. Let's do some of each.
Right.
Because wherever you put, the employer puts their dollars, it doesn't impact where the employee will put their dollars. They're going to put their dollars in the traditional account. And then at retirement, you have the option to keep them there or roll them over.
Right.
You roll some of them into the Roth account and some of them into the traditional account.
And so we've worked with several doctors and healthcare professionals, and they oftentimes comes with the option of a 403b or a 457. What is the difference between them, and why would you select one over the other for them?
I don't know. What do you got?
Well, the 403b, many times 403b and 457, they're for nonprofit organizations such as the hospitals and schools and that nature. And for the 403b, it acts like a defined contribution, but it really isn't. And so in that instance, they could select that. But the 457, they could do additional contribution to that, and that more acts like a deferred compensation versus a defined contribution. So if they have the option of doing both and can afford to do both, then we normally say go ahead and do both, because more savings cannot hurt your future.
Yep, and this is where employer-sponsored plans have a piece in the retirement income. And we talked about Social Security being a piece. and the retirement plan being a piece, and then personal savings. And so many times when you're starting off, you don't have the money to be able to fund all of these things.
Right.
But we say start off with typically the 403B, where we may get a match, save some after-tax money, and then decide, can we contribute more? And for those that have the 457 option, let's defer those dollars to retirement.
Right. And like for the 401k and the 403b, because employees have the option of saving into it at a certain amount. This year they could save up to $23,000. If they're over 50, they have the additional savings that the government said you could put more to catch up. They call it catch up. It's not a word that we love, but it's just additional savings. And so they could go for 7,500, which means they could save up to 30,500 this year. So that's a great way to really fund your retirement if you can afford to add those numbers in.
Yeah, and this is another point I want to make, because there is a difference depending on what your salary is, of how much an employer-sponsored plan is going to help you in retirement. So if you're earning $50,000 a year, and you can save $30,000 of that, that's 60%.
Yes.
You're going to have a great retirement.
Right.
For two reasons. One, you're saving a lot, and two, you're not spending a lot. You can retire early.
Right.
If you're earning $500,000 a year, and you're saying, I'm maxing out my 403B or 401k at 30,000, that's not a big percentage of your earnings.
Right.
And if you're spending everything else, then you're going to have a tough retirement. And so this is where we work with clients to change their habits to, in that case of someone earning $500,000 a year, max out your 403B, your 401k, get the match. If you can, save to a 457 an additional amount, and probably on top of that, have individual retirement account, either traditional or Roth, save to that using the backdoor Roth, and in addition to that, save some more into a taxable account, so that you're saving a bigger percentage, like maybe 30% of your earnings instead of 10% of your earnings.
I don't know much about sports, but you're knocking it out the ballpark here, Dan, with some great points. And so as you said that, all I'm thinking of is if you're making $500,000 and you're thinking that you could contribute 30,500. So for people who are doing that, they have to be careful, because number one, it's a percentage that they have to calculate. We often help our clients with that. And apart from that calculation, they have to ensure that they are not maxing out that contribution too early in the year, because if they do, then they stand to lose out on the match throughout the rest of the year.
Yeah, each employer and each payroll company is different on how they make the match, if the plan allows for the match. So you want to make sure that's done right.
Yeah. So, all the great listeners out there, take the time to read that plan document. It's important, because you don't want to leave free money on the table.
Yeah,
not when you can get free money.
Yeah, and just to explain that a little bit, if I can save $30,000 a year, I could do a little bit every month, or I could do it all in January. And if your plan matches your contribution, then they're only matching the January payment if you do that. And you're losing out, Michelle was saying, you're losing out on the other 11 months of match. And so if that's the case for the plan, then we would say put most of it in January, and then a little bit along the rest of the pay periods, so that you collect that free money along the way.
Right.
But some match the year's salary, but that's why we say check the pay stub to see what's actually happening.
Exactly. So just to switch a little bit, we're going to talk about VRS, and we are from Virginia, so the Virginia retirement system, and we also have the FERS, which is the Federal Employment Retirement System. So we know that that's for federal and civilian workers. So with the VRS as well, Dan, you've had a couple of clients or more that came to you to talk about the PLOP system there. Is that something that you want to expand upon?
Well, just that we do it. Virginia allows you to take a one-time payment at retirement. And what it does is gives you money now, and you can either take it as taxable income or put it into an IRA, and it will haircut the rest of your pension. And sometimes there's a need for that, which is why it's allowed to pay off the house or to cover some expenses at retirement, maybe move or something. But it's a decision that should be discussed, the ramifications of taking the money and doing something with it versus lowering the pension for the rest of your life. It's an option, and some take it and some don't, but it's worth a conversation.
Right. And even with the FERS, the Federal Employer Retirement System, we've had clients who come to us to help make decision on that as well, as to when is the best time to, based upon their age, to start that, because that acts like an annuity, and they have to at least be working 5 years to be vested in it. And so they often come and seek our advice as to the payout and the structure of that to get help. So if you're out there and you're getting ready to retire and you need help, the professionals are here to help seek our expertise in these areas, because we have learned and studied these things.
Yeah, and there's choices to be made, and your employer will give you these choices, but what they won't know is what we know about our clients. We know what Social Security benefits they may get. We know what other assets they have that'll support their their retirement, and we know that this is a piece, although important piece, and for some maybe not as significant as a lifetime benefit of Social Security.
Right.
And some it swamps the lifetime benefit of Social Security. So to look at those pieces together is the best way to do it.
Right. And we do know, too, that some of these retirement plans sometimes don't integrate with Social Security. So that's also an opportunity for planning with a financial advisor to ensure that if you are getting ready for retirement, that, that question that lingers, would I have enough? We could run the calculation and help you to figure out when is the best time for retirement. So seek professional advice before you retire. That way you have an answer to your questions, and then not just be in retirement and wondering, will it be enough for retirement? Yeah. Anything else that you want to discuss, Dan, on the employer-sponsored plan?
No, I think we're good.
Okay.
It's important. And like we mentioned, start with good decisions when you are new to that employer. Get the right plan for you. Do what you need to do for your career, and then talk with somebody about the options at retirement.
Right. And outside of employer-sponsored plan, like Dan mentioned earlier in this episode, it's great to have other savings vehicle. So tune in for the next episode where we talk about the different types of savings vehicle that you may want to consider having. So as we conclude today, and Dan and I unravel this mystery of retirement and employer-sponsored plan, and how critical it is to be saving for your future self. We enjoy this episode, and we thank you for tuning in with us, and continue tuning in for more episodes.
Thank you for tuning in to today's episode of the Joss Brown Podcast. If you'd like to see more episodes, visit our website at jossbrown.com.